Good day and welcome to our panel event on anti-ESG movement and growing scrutiny of ESG investing, hosted by the UTS Business School. My name is Lorenzo Casavecchia, and I'm the Associate Head External Engagement of the Finance Department. On behalf of the UTS Business School, I would like to welcome our audience, colleagues, and industry panelists. We have close to 100 registered attendees from Zoom to YouTube, so thank you all for joining us today. First, I would like to acknowledge that at UTS, we are on the land of the Gadigal people of the Eora Nation, so I want to pay respect to the traditional owners of the land that the university is built on. A quick disclosure for you, the panel discussion is recorded for educational purposes. Also, you can post your questions in the chat and we will pass your questions to the panelists at the end of the session if we have time. I have the great pleasure today of moderating a terrific group of industry panelists who are going to share their insights on this topic. Kristy, Chief Executive Officer at the Australian Sustainable Finance Institute. The Institute aims to realign the Australian financial service system to create a sustainable, resilient, and inclusive Australia. Tim King is the Chief Investment Officer at Melior Investment Management and a leading equity impact fund in Australia. Désirée Lucchese is the Head of Ethics and Impact at Ethical, one of the first and largest ethical funds in town. And Leilani Weier, who is joining us today as well, Head of Responsible Investment at the Industry Super Fund REST. Joining me today as co-moderator is also my colleague, Dr. Deborah, who is a senior lecturer at the UTS Business School. I'd like to welcome all the panelists. We are very grateful to you for joining us today, and thank you very much for your time. So I would like to spend a couple of minutes just giving you high-level observations to frame the discussions today, so you have the backdrop for the conversation. Let me begin by saying that the amount of institutional capital ostensibly invested based, at least in part, on environmental, social, and governance, or ESG considerations, so an unprecedented surge in the past 5 years. Based on the latest statistics that many of you, I'm sure, have seen, ESG is now a $35 trillion asset under management mammoth. The more general category of responsible investment reached $1.5 trillion in Australia in 2021. For its proponents, ESG represents a synergy of profit and social purposes, doing well by doing good, as some put it. But 2022 was a year of reckoning for ESG investing, with a major market correction, an energy crisis, high inflation, and rising geopolitical risk. According to data from Morningstar, only 1/3 of ESG label funds outperformed their non-ESG peers in the past 2 years. In Q1 of 2022, flows into ESG funds decreased globally by 36%. And ESG investment returns dropped in Europe and in the US by between 11 and 14%, according to Bloomberg Intelligence. At the same time, the rising anti-ESG tide is discrediting efforts to incorporate climate science and ESG factors into financial valuation models. It was only of this week the announcement by Vanguard, a $7 trillion investment manager, of its decision to exit the net zero initiative, a serious blow for some to their initiative. On the corporate side, a KPMG survey last month indicated that global CEOs are putting ESG goals on hold to prepare for the recession, with 59% of them claiming they will pause or even reconsider their ESG efforts in 2023. So these events have triggered a closer look at ESG and raised questions about its proper role in fiduciary investment decisions and its ability to deliver on financial goals, not just societal goals, but also on financial goals. I would like our panelists today to discuss some of the primary concerns and criticisms surrounding ESG investing, cover some of the recent regulatory changes in this space, and evaluate whether the amorphous nature of ESG, for which there are now over 600 disclosure provisions globally, calculating ESG scores in many different ways, may explain to some extent many of the perceived shortcomings of the politicized wave of anti-ESG efforts. So, Kristy, thank you very much for joining us today. I would like to start with you, if that's okay. ESG has faced the rise of anti-ESG efforts, as we know, and some sort of an identity crisis this year. Can you please describe for us what's going on in this space with the anti-ESG movements, and to what extent you think they might really pose a threat to ESG at a time of heightened scrutiny of ESG investing? What are your thoughts?
Yeah, so the work that ASFI does is Australian focused, but it's clear that some of these rising anti-ESG movements are being driven by politics in the US and having bleed over effects obviously globally because of the role of US-based financial institutions in global capital financial markets. So Australia, I don't think, will be immune to some of those factors, but the political context is very different in Australia. And I think with the change in government in May, we've now got a federal government that is much more aligned and sees the value from a financial system perspective, as well as sort of a broader Australian economy and future prosperity perspective, and sees that role for sustainable finance and ESG related factors. So we've seen just this week the announcement of a consultation process for climate-related disclosures, bringing Australia into line with many other markets where mandatory climate disclosures have been introduced for both corporates and financial institutions. And there's a strong indication that following the developments in the International Sustainability Standards Board, the government will introduce legislation next year to make those disclosures mandatory in the Australian context as well. The announcements from the Treasurer also indicated that while the focus is on climate, government has a clear view to broader ESG factors as well, and it's a climate first rather than a climate only approach that the Australian government's taking, very much in line with where the financial institutions and finance sector is thinking about the integration of these ESG factors. So yeah, I would say globally there's definitely headwinds, and I think increased scrutiny about claims being made about not just integration of ESG risks, but the sustainability outcomes that some of these products are creating. And more than happy to talk about particular tools and sort of policy and regulatory approaches being taken a little bit later.
Fantastic. Thank you, Kristy. Deb, you have any questions for our panelists?
Tim, I'm wondering if you can give me some idea if this movement is actually playing any role in your investment decision making. So has it had any impact at all?
Did you mean the anti?
Yeah.
Well, we don't see it at all. So I think, as Kristy said, it's mainly a US phenomenon at the moment. But rather first of all, I think the scrutiny is good in many ways, because I think there's been a lot of jumping on the bandwagon by all institutions, right? Money managers, companies, and making, I think, very questionable claims around a whole bunch of ESG factors, right? And net zero would be a prime example of that. And I think that's really good that that's getting scrutiny, right? Because there is a lot of greenwashing in the system. So that's point number one. But rather, we've had the opposite experience, and that is that companies see that ESG represents a whole bunch of risk, but a whole bunch of opportunities, right? And managed effectively, it can minimize risk, and that risk can manifest itself in a whole bunch of different ways. It could be legal risk, it could be reputational risk, policy risk, whatever, but it's also opportunity. The number of companies that I speak to recently saying that by introducing diversity throughout the entire company has increased decision-making and enabled them to attract more talented employees, particularly with this talent shortage at the moment, is actually a significant value creation opportunity for the company. And those companies are actually reaching out to us. And so, for example, I did a presentation to a board of a major listed company 2 days ago, and they said, how do we integrate ESG more effectively into our business? Because this is actually a risk creation opportunity, a value creation opportunity for us. So I think that actually it's ironically pushing the case for more genuine ESG measurement and integration. I think that's a good thing.
Yeah, I think it's probably a symptom of that. Europe contributes 83% to the assets under management in ESG and ESG integration. So with the US, I think last time I checked, is only about 12 to 13%. And this being a US focused phenomenon, I don't think it will probably have a major impact, but it's definitely a symptom of a more general issue that is concerned with, I guess, the amorphous nature, as I was saying previously, of ESG. Thanks, Tim. Désirée, question for you. What is your view on the so-called ESG measurement issue? I mean, there was an article a few months back on The Economist that claims that, I'm sure you read and you're familiar with that that ESG has a definitional problem, a measurement problem, and a financial performance relationship problem. I mean, of course, that's the economist's view, not necessarily buying that view. But one of the problems is, of course, the measurement. And we know that different ESG ratings really have very low correlation of only about 0.5 across rating providers. So do you think that differences in ESG regulations, the SEC has a new regulation, it's under proposal now, it's probably going to kick in 2013. The EU has the Article 6, 8, and 9 regulation for funds. And of course, now, as Kristy was mentioning previously, there is now the push from Australia to enter the space. Do you think that these differences in the regulations across jurisdictions will cause greater or lower ESG rating disagreement? What are your thoughts on this?
Okay, 2 points there. The argument about the lack of correlations of ESG providers and rationales is more of a red herring in a way. We review broker research data, so we have the responsibility to ensure the methodologies we rely on are methodologies that, in our view as investors, are credible and robust and align with our views. As Kristy and team have also mentioned, we are seeing a harmonization of reporting standards. So if on the one hand, the Sustainability Accounting Standards Board, now part of the IFRS Foundation, is addressing the materiality of ESG risk to companies, so the bottom line, the Global Reporting Initiative and other frameworks and standards have addressed a sort of double materiality, the impact that might happen to the bottom line and the impact that might happen to the real world. The function that the ISSB, the International Sustainability Standards Board, is now playing is bridging those metrics and the agreement that already exists on a very large number of ESG indicators. So I think we can agree on basic definitions of sustainable indicators or human rights indicators. The same with taxonomies. There are commonalities that we can start to rely on, and it's fantastic shift that we are seeing in the market. As for the debate about the regulators are also trying to scrutinize a bit of a wild west of enthusiasm in claiming performance and alignment to SDGs or ESG outcomes and impacts. So having the greater clarity and direction from regulators is also harmonizing with the SEC, the ACCC and ASICS in Australia. The UK regulator, the FCA in the UK, has just set up a whole new advisory panel to again address sustainable finance. So we are seeing a lot of harmonization. So it's just an idea whose time has come, really.
Thank you. And you were mentioning the ISSB, which is obviously going to be what the financial reporting standards has done for accounting. The issue that I have with that, or at least, it's not clear to me, is that, the ISSB is looking at single materiality, a bit like what the SEC is proposing in the US, but the EU is looking at double materiality. So how do you think these two sort of approaches can be reconciled together if you are a global corporation with the divisions across the different sort of jurisdictions, or a fund with a global portfolio?
I'll be short here because, in my view, regulators have a challenging role to basically satisfy different expectations of stakeholders, and they might not get it right. I believe that Article 6, 8 and 9 are not getting it right, but they are helping reflect on definitions and helping investors position their products. So I believe that the answer here sits with investors and their time horizon and their fiduciary responsibilities, particularly for a long-term investor. It is critical to consider the double materiality, because if the system is failing, the financial stability of the system will fail. And we are seeing numerous trends across diversity, equity, climate, cybersecurity, not receding. So how are we going to manage the systematic risk in our portfolios, or from a total portfolio perspective? It's by addressing double materiality.
Thanks, Désirée.
Leilani, I wonder if I can bring you in here. I've been at a conference recently and there was a lot of discussion around the kind of two sides to how you should be investing if you're, sustainable investors. So first of all, the idea was that you should actually be investing in so-called brown companies with the goal to influence it to improve its sustainability, or whether in fact it's actually preferable to only invest in those already aligned with your investment goals. And a little add-on to that, if you're doing that, if you're just aligning with your own investment goals, there's also another question about whether or not you're actually ending up with a well-diversified portfolio or not. And is that any concern?
Great question. Okay, so just to introduce you to REST quickly. So REST is an Australian super fund. We represent 1.9 million Australians, and therefore we invest on their behalf with a lot of responsibility. So we have a net zero by 2050 ambition. And on the green brown, so the way that we look at that primary is to give our members choice. So you can be in the REST core option, which will be an option that is heading towards net zero by 2050, or there's a choice option where you can be called sustainable growth, where you can be in an option that actually looks at fossil fuel companies and has a set of other ESG related criteria, and you can choose to be in that option because it won't be invested in fossil fuels. So I think this is around investment choices for consumers and also, as asset owners who are working with our investment managers on investment strategies. On the green-brown split, in our core portfolio, which is if you're a REST member, you'll default into a core portfolio, there will be a mix of assets. Some will be in the brown category and some will be in the green. And coming fresh from the Principles of Responsible Investment annual conference, one of the key themes of that conference was, and actually we can't divest our way to net zero. So we have to use our active ownership skills and capabilities to engage with companies. However, we are talking about anti-ESG movement today, and actually Climate Action 100+, we're members of that initiative. It's a collaborative engagement for the top emitters around the world that has been targeted in the anti-ESG movement for antitrust issues. So it's about how we engage and when we engage and being very transparent about what we do and what we don't do. So I could talk at length at this, but I'll leave it there. And
thanks, Leilani. And I just want to circle back and go a little bit deeper on these regulatory changes in Australia. So, Kristy, you were mentioning the latest, introduction, the latest regulation or the proposal by the government to address greenwashing. So the government announced a new national sustainable finance strategy, and is considering, among other things, the national sustainable finance taxonomy, building on the industry work led by the Australian Sustainable Finance Institute, RIA and EY. In what way does this new Australian taxonomy differ from, say, the EU taxonomy? So why do we need an Australian specific taxonomy, and what is that related to the sort of composition of the Australian market, and how can it be harmonized to ensure that capital markets have a common global language in this space?
Yeah, very good question. And the interoperability of taxonomies as well as sort of disclosure regimes globally is of critical importance, given that capital and financial markets are global. So that's something that in the work that we've done so far, we've been very focused on making sure that we're connecting up with international jurisdictions who are a bit ahead of us in terms of developing their taxonomies and aligning as much as is possible. But I guess the crux of your question is why do something different in Australia? Why not just adopt the EU taxonomy? And the short answer to that is coverage. And because of the shape of Australia's economy, we are very different in terms of fossil fuel intensity and emissions intensity of the economy. There's only 1.5% of the ASX 200 that would fall beneath the EU taxonomy sort of green classification. So it's clear that the reason that countries use taxonomies is to allow investors in the finance sector to differentiate between activities and assets that are currently sustainable. The next generation of taxonomies is also identifying those activities and assets that are supporting a transition to net zero 2050. And the EU taxonomy doesn't currently have a transition category. Given the transition challenge that we have as an Australian economy, that will be critically important for an Australian taxonomy to be able to enable the flow of capital to support those transition activities and those companies that are on a net zero 2050 sort of credible transition pathway. The other element of why Australia needs to have a look at this itself rather than just adopting from other jurisdictions is usability. And I think as the EU taxonomy is now being implemented and reporting is coming both from corporates and financial institutions against the EU taxonomy, it's clear that it's very complex and the data required to report against it is not available in many cases, which further reduces sort of the coverage that the EU taxonomy has and its utility as a tool to support capital allocation. So the idea ultimately is that these taxonomies, international jurisdictions would be accredited in the same way that sort of tax treaties have mutual recognition, and that would happen with taxonomies. And there's a range of sort of international discussions around the process for that. To make sure that that can happen, it's really important that an Australian taxonomy is scientifically credible, developed with a firm view to alignment with some of these international criteria, particularly around what is already green, and the international partnerships that we've already developed as part of this work have been really a critical foundation to ensuring that as we move forward with the work.
Very clear. Thank you very much, Kristy.
Thanks, Kristy. Tim, I wonder if I can come back to you, please. And just with the fact that you're going to have a lot of interaction with companies and you'll know a lot more about what they're doing really than we will from the information that we get from annual reports and things. And what I was wondering is if companies are starting to form, if you like, ESG committees, possibly with suitably skilled teams at board levels, perhaps. And committees, I guess what I'm thinking is that might be similar to kind of a remuneration committee or an audit committee. Is that happening at all?
No, that's definitely happening, Deborah. So we're seeing much more evidence of the ESG committees being established as separate entities. Sometimes they continue to be wrapped up in the risk committee, but there's certainly even within that risk committee a specific carve out for ESG considerations. I think the bigger issue is that are the members of the board sufficiently skilled and experienced to understand what ESG means, right? Particularly implementing that in a strategic sense, right? And I say that in the context of a Deloitte report that was issued earlier in this year, which talked about the skills required for directors of companies are much, much larger than they used to be, right? Because they've expanded into these new areas like climate change, social license, cyber. These are all new issues and that boards need to be cognizant of and experienced in. And the question becomes, is the director community in Australia up to the mark in terms of understanding those risks and governing them in a governance sense? So I think that it's one thing to set up the committee, but are the committees appropriately populated? And I think that's a big question, right? Because as I said, being a director, and I'll give you an example. I'm on one of the TNFD working groups, rolling out TNFD, which is Task Force on Nature-related Financial Disclosure. If you look at Kristy mentioned ISSB, and so we have ISSB being rolled out. There's a climate standard that's already available to review, and if you look at the future standards under ISSB, there's going to be one on biodiversity, right? And so as a director, how do you understand biodiversity risk in your business, right? That's super complicated. And so, I think there's probably a long way to go in terms of upskilling directors of companies to understand all these new risks in their business.
Yeah, well, it becomes very technical, doesn't it? The biodiversity.
Well, biodiversity
kind of
is
idea.
one example where you actually need, biological, botanical experience as well or at least some expertise on that. And how do you get that and how do you inform your view? Yeah, so I think it's quite demanding and quite complicated. And given these reports are designed to be auditable, and if they become mandatory, directors have to sign off on these reports, so they have to be accurate. I think that's quite a big demand.
Yeah, I've got a PhD student who's doing impact investing with biodiversity, and the biodiversity part, I just have to go, okay, she's studied science, so fortunately I can leave that to her. But thanks, Tim. That's that's a really good point. Désirée, maybe if I can come back to you, just around the regulations again, if I can. But we've got this diverse set of regulations and mandates occurring. And I wanted to know how you navigate these. So the global idea of it becomes particularly complicated. I would have thought, in particular, with something like your international equities trust. Do you, does that sort of impact there, or is it impacting you more broadly than that?
The approach is the same. We're trying to integrate and evaluate in depth all possible risks that might affect the fundamentals of our shares and fixed income securities. So, but I'm actually, if you're talking about the international landscape, I just want to remind the audience that Australia is a very vulnerable country to climate risk. So we might be talking about disclosures and taxonomies, which are both very important for investors to have, investment useful information. But the reality is that nature doesn't do bailouts. Nature is not waiting for, transition products. So there is an urgency that we need to prioritize. It's difficult. Taxonomies are only one little component in a bigger ecosystem that we have to build. And that's why ASFI's role has been so important in the country when we lacked the leadership. But the reality is that we have to build a whole ecosystem of regulatory changes to the way, prudential regulation is operating at the moment, the way, securities laws are working. And we can't let the guard down for what's happened in the US, because the US debate was driven by the Dodd-Frank Wall Street reform. Basically, they reviewed after the global financial crisis, the Democrats reviewed all the possible financial services regulation in the country since 1964 without involving the Republicans. So that led to a very bitter and split partisan way of handling politics. What can we learn from that, being also a country hostage to the fossil fuel lobbyists? That's what we have experienced to date. So I think ASFI can leverage this, collaborative undertake across the leading insurers and, fund managers and financial service providers and civil society to try and advance the ecosystem. So we haven't been really directly affected in the way we manage our trusts and investment trusts. But what we have done to basically monitor the shifts in the debate, the discourse, is to ramp up our advocacy work. So as of January, actually probably as of next week before I go on holiday, I'm starting big reviews of the safeguard mechanism submission, the carbon disclosure, a consultation that will take place on the nuclear energy, just because we need to be cognizant that we can influence a limited extent of corporate change in one-on-one discussions. We have to look at the enablers. What are the regulatory enablers, the media enablers? Where are the different levers of influence?
So that's interesting to me. So one of the things that I've been looking at recently, at the moment, they're talking in the US about requiring scope 3 emissions to be reported from, I think, 2024. I'm guessing that number a little bit, but I seem to recall that. but at the moment we don't have any such requirement here, and I haven't sort of seen any indication of it. Is it that sort of thing that you sort of, I mean, that's a very small example, I suppose, but is that sort of thing that you're wanting to be more broadly incorporated from a, requirement point of view?
Yes, and I understand it's a really, really difficult challenge. At the same time, the discussions I have with accounting experts is, okay, if we prevent this burden on companies, right? If we lift this burden on Scope 3 disclosure, how are we going to understand where the boundaries sit? So since 2015, I've been advocating my peers to focus on Scope 3 boundaries. So why have we not invested or dedicated our resources to figure out where these boundaries sit? If we're looking at the input-output databases, they are very outdated. So those are big country-level industrial databases. The data is old. It doesn't make sense. So can we estimate our way to figure out climate risk? No, we can't just estimate. We need really the good quality data to then overlap where the boundaries, sit to avoid the double counting, right? If we want to reduce emissions or offset them, if they're marginally there, still we need to understand all boundaries. But it is a burden for companies. So where is the concessionary finance? Where is the guidance? Where is the auditing help, right? So there must be a collective effort to work towards boundary delimitation. So I don't have the answer, but yeah, I would support any advocacy group to try and figure it out.
Yeah, no, the question got a bit big there. Sorry, Désirée.
If I can jump in, given that, Leilani, you are in the super fund industry, and the super fund industry has been buffeted by quite a few rounds of regulation from APRA, starting with the, the recent performance test. I mean, it goes back to 2021. That makes it a little bit difficult, from my understanding, for super funds to incorporate high tracking error ESG activities in strategic asset allocation. So to me, this seems a little bit like a real tension between economic incentives propagating from APRA's performance tests that have attracted quite a significant level of criticism from the industry, and obviously a performance test that focuses on financial performance of super funds. And the new APRA's prudential standard, I think, is SPG 530, expecting super funds to instead take into account the full spectrum of ESG risks. So a little bit of a conflict there between what APRA would like from super funds in terms of financial materiality, and then also these additional layer of regulatory intervention that instead is looking for the incorporation of ESG risk. So what are your thoughts on this?
Well, first of all, I definitely agree with you that super funds have certainly had an enhanced regulatory environment in the last few years. That is absolutely true. And on the performance test, it's a really interesting dichotomy, because the performance test asks us to look backwards. How's our performance been for the last 7 and now 8 years in the latest one? And yet the climate change financial guidance that came out, CPG 229, asks us to look forward. So it's a forward-looking horizon that, takes you into the 2030s and the 2040s. So that alone is quite an interesting dichotomy, that we look back for one and are looking forward for another when we're doing our scenario analysis. And then on top of this, there's a consultation going on, as you mentioned, about investment governance, and huge support for ESG integration throughout investment governance. And that's through the whole process, our investment strategy, how we select, how we monitor, particular call out to climate risk with our stress testing. So really, we are in a current environment where we're looking at how to make all of this work. And part of that, you mentioned tracking error. It's about being smart about where you use your risk budget. That's ultimately what it comes down to. So having strategies in terms of equities where you'd have a core portfolio that is very, sort of benchmark aligned versus then giving yourself some risk budget to do some what could be perceived as more interesting investments, so you can start to bring in the the green investments that Dr. Deborah was talking about earlier. So it's just being smart about how you invest ultimately. The regulatory environment is positive. Like it's providing guidance, clarity, comparability, consistency. That gives our members assurance. That should give consumers assurance. And we're the investors. We know how to manage risk, so we will work through it.
That's good to hear. Thanks, Leilani. Deb, maybe we have another few questions before opening to the floor, or maybe some additional questions.
Yep, sure. So again, I seem to keep asking you questions, Tim. My question is really, what are the defining characteristics? So, technologies, corporate culture, that kind of thing, that you look at when you're investing in the company. So the other idea is, can you exert impact in listed equities effectively in private equity? But probably the first part, what are the there are a few key characteristics that you look at that may be different from what Leilani looks at, and that kind of idea, I guess.
Yeah, well, first of all, there's a massive, the reporting in the space is a dog's breakfast, right?
Yeah.
Because as we just discussed, there aren't any reporting standards. So, what we, when we look at a company, we look at, well, what's the company actually reporting on? And sometimes there isn't anything, right? And usually there's something, and rarely there's sort of comprehensive reporting with sort of ambitious, because it's not just about reporting. It's like, well, how are we going to lift the bar, right? Because our investment thesis is if we invest in companies that are more sustainable, those companies, for a whole bunch of reasons that I mentioned before, will be more resilient and will actually generate alpha. And that's been our experience. So we look at all those things, but really where the most important thing for us is when we meet the company, right? And that's frequently with the chair and the board of the company, but sometimes also with the C-suite, and what's their view and how they think about improving their ESG reporting and ambition. And if we get a clear sense that they actually genuinely want to improve and they see this as a value creating opportunity, that's a really important piece for us. So, we've got examples of companies where we've invested in where actually the reporting's like non-existent, right? But what the company actually does is actually important for a sustainable world as defined by the SDGs. And they actually, when they want to get on their journey and improve their reporting and ambition, and sort of we go on this partnership together, which comes to the second bit, we've got a really key role to play in the active corporate stewardship, right? And as I said to you, 2 days ago, we did a presentation to a board, and how that presentation occurred is that we did our regular company meetings, just like any other fund manager. We met the CEO and CFO, and we were talking about the material ESG factors for this particular company. And they said, look, this is really important for us. We're struggling because we don't really know where to move next because there aren't any standards and the issues are so complicated. Can you come and present to the board and help us on this journey so we can raise our ambition? And we can measure that through time, right? In terms of, how their reporting's improving, how their ambition's changing, right? So that we actually do get genuine impact. So the active corporate stewardship is crucially important to us.
There was a question in the chat for you,
Yeah.
Tim, as well, which said, with respect to your expectation of companies, is this graduated by their size?
Yeah.
Simply, do you have the same expectation for smaller companies?
It's a really important question because we're comparing large listed companies with teams of people working on this versus smaller companies with literally no one, right? I did a presentation to a company last year. I did a presentation to the board. And then I got a call after the meeting and from the company secretary and said, that was really good, really useful, but they've made me head of ESG, the company secretary, because they have no one, right? And so you get a lot of that where small companies really struggling, and particularly there's a massive talent shortage in the space, right? And so I could sort of set up recruitment firm on the side, but the number of times I get saying, do you know anyone who we can hire to help us map out our ESG, set our reporting, set our ambitions, from right across the industry, but particularly with listed companies.
I would like to consider the way forward for ESG and more generally sustainable finance. Kristy, there is data that shows that carbon emissions are going to go up 2 to 3% this year and projected to go up 10% by 2030, when they need to go down by 50%. So a very recent report by Boston Consulting Group shows that climate mitigation initiatives will require an annual investment on average of 3.5 trillion between 2020 and 2025. We are investing, so capital inflows into climate finance is at $570 billion. So there is according to BCG, there is an overall financing gap of 83%, which is non-trivial. Do you think that perhaps the management industry globally has been a little bit slow to catch up with the rising finance needs of emerging technologies such as, carbon capture and low carbon hydrogen production? What are your thoughts? I mean, do we need to, and what can we do in order to speed up and catch up with these, very large financial needs?
Yeah, I think there's a range of reasons as to why that amount of capital isn't flowing. And in the Australian context, part of that is because capital allocators don't have a clear understanding of which activities are needed, which activities are already sustainable. So this is to this taxonomy issue, clear definitions of those activities and assets that are currently sustainable or are on the path to supporting the net zero transition by 2050. In all of the discussions that we've had with banks, insurers, asset owners, asset managers, that's sort of a critical piece of the architecture that is currently missing and in their view would enable them to allocate a lot more capital to these solutions. There's obviously other parts of the policy and regulatory architecture, and there's the way that some of the benchmarks are created under the performance test does make it challenging. To some of the points that you raised earlier, there's not a private equity benchmark, for example. There's not an ESG specific benchmark, and I would say that is a barrier to large scale allocations of the type that you're talking about. And then there's also sort of an unfamiliarity with some of that technology and to some of the issues that have been raised about the skills and capability gap, really mainstreaming understanding of the types of technologies that are needed in the timeframes that we have to get to that net zero 2050 is something that really needs to scale up and skill up across the industry as well.
Thank you.
Désirée, can I ask you a quick question? It's we talk a lot about climate change. This is obviously, a big impact, and it's really important. And in some ways, relatively easy to understand because we can see, emissions, scope 1, 2, and some 3. What I wanted to understand is a bit more about how you compare the social issues of the ESG. In particular, I guess what I'm thinking about, Indigenous issues and those kind of things. Do they play a role? And perhaps Leilani or Tim might want to jump in on this as well. Do they play a role for you in your investing?
Yes, and they play a role particularly in certain sectors. So the resources sector, infrastructure, real estate, REITs. So anywhere there is a risk that projects or developments might be impacting local communities. So we did have an extensive engagement with other peers, with, for example, one of the leading miners in Australia. And the reality is challenging. So with ESG, we can't just take at face value the data that we purchase. So we need to talk to stakeholders, and that's time consuming. It's not just not having understanding. I think sometimes there is a cultural barrier about respecting stakeholders. So in our view, I don't think it's that we don't really understand what sustainability assets are. I think it's more having the right price and having the right openness to respect stakeholders and account for different stakeholders as critical enablers for our, portfolio companies and the regions where they operate. So it depends on the type of securities, and we seek out and trying to ascertain that the reconciliation action plans are current, and their actual SDG alignment is core to the business of the companies we invest in. So we just do not want to see pretty alignments or rainbow washing. We try to have a consistent approach to stakeholder engagement with clear plans, maintained commitments, and an alignment to the core business. So if you're a miner, that's a priority for you. And so respect for First Nations is top of mind.
Leilani, I just want to close maybe with our questions today. There is an ongoing discussion about whether reporting by investors should focus on the impact of ESG issues on risk and returns, or whether it should be extended to the real world impact of investments. Well, what's your view on the feasibility of actually extending fiduciary duty to the real impact of investment, which seems to represent the next frontier in this field, according to the PRIs? Well, what are your thoughts on this?
Yeah, so first of all, what I will say is we've spoken a lot about ESG investing. Now, ESG investing is, it's for me, quite an American concept of a fund. Most portfolio managers would probably have said that they've been incorporating ESG into their investment process for years, whether it's voting on who the board member's going to be, whether it's voting on a remuneration package or proposal. So this concept around ESG investing has been a little bit conflated with climate, quite frankly. And RIA, our Responsible Investment Association in Australia, has got this fantastic spectrum diagram that tries to show you all the different types of responsible investment, with ESG integration being one, and then, negative screening, positive screening, thematic investing being all the other types. So just really good to get our hands around that first. So the PRI have done some work. They have a paper on direct fiduciary duty and impact or sustainability outcomes. And the view in this paper very much, and actually in hearing the authors of it speak, are actually saying the next 10 years for investing is all about ESG integration. So what are your risks? Those risks could be in the next 6 to 12 months. And then what are your sustainability outcomes? So it's actually the yin and the yang to your investing process. And I think as super funds are becoming more and more comfortable with being able to put a cost to the benefits of that sustainability outcome, which we have done in our climate modelling, that's actually giving comfort to actually saying, well, actually ESG risks and then the sustainability outcomes that are being produced by managing those risks and finding the opportunities is actually protecting our investment portfolios over the long term. But it always has to be materiality based. We're not, as you know, the financial industry cannot be looked at to solve all of the world's problems alone. This is a collective problem.
No, I do agree, and indeed, I found it difficult to understand how that extension to real impact of investments can be incorporated in fiduciary duty. But I think we just need to wait and see. I mean, Deb, are there any questions in the chat just to address some of the concerns or questions of attendees?
Yeah, so there's one bit of a long one from Patrick Langrel. The US is significantly more polarized than Australia around social and political matters. So we've sort of talked about that a bit already, I think. What the question is what modifications could be made to ESG to recognize these underlying differences, so to possibly reduce the anti-ESG mentality, which is often based on the impression that ESG is taking away value. Any answers to that from anyone?
I'm going to put my hand up.
You go, Désirée.
Because, the new generations are really worrying about inequality, access to jobs, the climate. So I think ESG is just hygiene for investors. We are just looking at risks. We're looking at materiality. So whether we want to look at impact is another matter. And I think actually the future of ESG investing, I think, will be impact, will be sustainable finance, access to good issuance, right, in the credit markets, for example. So we don't really need to address the politicization of the debate in Australia, but we need to be mindful of what might cause us to really lose the direction. So the direction should be fiduciary responsibility, managing materiality and material risks, identifying prospective opportunities, ensuring that companies are disclosing the good data that indicates what their future prospects are, what's their future viability, how long they want to be in business, and working across different parties, as ASFI is doing, to lead and collaborate with government to make the environment an enabling one, a market that is viable for the future.
Tim, if I can ask you a question, I think it's directed to you, a question on YouTube, a comment from attendee that says, where do you see some of the challenges in terms of being able to move forward on sustainable investing? What's holding you back at times?
Oh, okay. Well, I think that one of the key challenges, as I said, this dog's breakfast of reporting, I think that's a challenge, right? So sifting through all that and understanding reality is complicated. I think, so two other things I hear all the time. Number one, you have to take a haircut on returns if you invest in, as Leilani said, there's a whole suite of different ESG styles, but there's this general presumption, which is no longer as much the case, but still this what discount do I have to take on returns? Well, that's a complete fallacy, right? If you look at the leading academic research, if you look at a whole pile of broker research, if you look at our own experience, and we're benchmarked against the ASX 300, we don't have any tailwind from any specific ESG benchmark, we've outperformed, right? And so this is just a smart way to invest, right? And so I think once that's better understood, and I think that helps solve this push. I think a lot of this pushback on ESG is that the assumption that you have to take a discount on returns. And I think the evidence is very compelling. That's absolutely not the case. The other pushback we've had is, and we started with zero FUM 3.5 years ago, and the pushback, how are you going to be able to meet with companies? We haven't had any problem meeting with companies because the smart companies are going, we need to take this seriously because this is an important business factor, right? So ESG is sometimes referred to as non-financial risk. Well, the thing is that non-financial risk translates to financial risk ultimately, right? So, I think once those fallacies are dispelled, and I think they are progressively being dispelled, then I think that basically this may sound like a sort of aggressive call, that all investing becomes ESG investing ultimately, right? Because we're just understanding and managing the risks of businesses.
I guess your answer is also addressed another question on YouTube about the relation with between ESG and financial performance. You've already tackled that one, so it's fantastic. It's very good. The clock is ticking, so I'm very conscious of time, and I would like to round up the event by thanking our panelists today on behalf of the UTS Finance Department, Kristy Graham, Tim King, Désirée Lucchese, and Leilani Weier for sharing their time, their views on the issues discussed today. And also, I should say, for the great work that they are doing to pioneer in this space. Deb, thank you very much for your help with the moderation. I guess this is an area where we are all learning, where there is a lot of opportunity for innovation, no doubt. And it's obviously complicated, but it's moving forward, and in my view, is pretty exciting. Before closing the event today, I would also like to remind all of you on Zoom and YouTube to stay in touch with us by visiting the LinkedIn page of the UTS Finance Department, where you will find announcements on free and exciting events organized by our department next year. Until then, thank you all for attending, and good night. Thank you.
Thank you.
Thank you.
Thanks very much.
Thanks.
Good night.
Thank
Bye-bye.
you.